Hello and welcome to this webinar, and thank you for listening for an update on the Embark Horizon funds. I'm Alex Lyle from Columbia Threadneedle Investments. I'm head of managed funds and I am manager for the Embark Horizon funds. Just to start with, on slide one, I thought it'd be useful just to have a quick run through of how the funds are run and the different roles that different organizations have. E-value set the strategic asset allocation for the funds. So that's looking at the long-term expected returns they have and volatility they expect from asset classes. And they update that strategic asset allocation between the major asset classes on a quarterly basis. Then we at Columbia Threadneedle aim to add value for your clients through tactical asset allocation, which is taking us a rather shorter term view to e-value, but still a medium to long term view. We're looking really at sort of 6 to 18 months. So taking a tactical asset allocation view around e-value's benchmarks, and we're looking to add value by stock selection, stock picking in our equity and bond funds. So what this chart shows at the bottom is the bands that we can operate within around e-value strategic asset allocation. So how much we can overweight or underweight each asset class. And it gives us a reasonable spread there. But at the same time, for risk control purposes, we're not going to be able to go miles away from the strategic asset allocation, but it's certainly a big enough band to be able to add some useful value. So that's the different roles in managing the funds. If we move on, we can see that is the latest strategic asset allocation benchmarks set by e-value for the current quarter. So just to show you roughly where each fund is going to be in the major asset classes, and within bonds, which bond types, and within equities, which regions. So moving on more specifically to what I'll concentrate on today, which is our current views on the different assets and therefore how the funds are currently made up. And this is the Columbia Threadneedle asset allocation matrix we're showing here, showing our preferences for the different asset classes. And you can see on that top line, we favor equities. Within bonds, we favor credit, i.e. corporate bonds rather than government bonds. And we dislike government bonds. We don't see much value there. Drilling down further into that equity above benchmark position, we show which markets, which regions we like particularly, and you can see on the right hand side our most favored market is Asia ex-Japan. And the reasons for that really that the economies over there are in pretty good shape. They were first into COVID, they dealt with it in a rigorous manner and have come out in really pretty good shape. China actually was the only major economy to show growth last year. No mean feat in 2020 to have positive GDP. But at the same time, we can see some great corporate opportunities in that part of the world. There's some excellent IT businesses, things like Samsung, very strong in mobile handsets and chips, and everyone's short of chips at the moment. Alibaba, the huge Chinese platform for all sorts of online activity. And there's some great plays on the growth in wealth in China. That theme continues. So companies that are involved in education, travel, insurance, some great opportunities. So that's our most favored region. The US, we also like, again, the economy there is one of the strongest in the developed world. In fact, last week, the IMF came up with their latest forecast, and they're actually now expecting the US economy to be stronger in 2024 than they had forecast it would be before the pandemic. So more than full recovery by 2024. That's a good position. Also, the Federal Reserve there has taken very strong action to get the economy going, and Biden's fiscal packages, the 1.9 trillion he announced a month or two back, and now talking of a $2.2 trillion infrastructure package. These are big packages. So strong economy, and similarly to Asia, we see great corporate opportunities in America. A lot of the world's global leaders in the places where you need to be for tomorrow, the Googles, the Amazons, the Facebooks, you don't find them in Europe. So the US does have a lot of attractions. Japan we favor. That's quite a recent move. And that is in light of the strength that we're expecting to come through in global growth, because the Japanese stock market is very geared to global trade, a lot of manufacturing activity. So we have moved that up to pick up on that change. Neutral elsewhere. Just to elaborate on EM, we do like EM overall, but we prefer the Asia bit of it. So that is reflected in the strongly favored bit. The rest of EM we're not so enthusiastic about, Middle East, Latin America, so that's why it's neutral. The UK has an arrow against it. That's because it's gone up very recently. We have been cautious on the UK. It's been a poor performer, but we do see scope for a decent bounce at the moment for two reasons. One, it has underperformed, so it's looking pretty cheap compared to other markets, but also it has become a very cyclical market in the COVID environment. We have a very service-orientated economy, lots of tourism, lots of catering, etc. And that is what COVID has really hit. Manufacturing has managed to carry on reasonably well, but an economy like ours has been badly affected. And therefore, as things open up again, and the UK is in good shape in that respect, we had a dreadful start to COVID, but since vaccinations have come along, we have upped our game significantly. And so we should come out with a really quite strong bounce in the economy in the second half of this year. So we think the UK should be able to do a bit of catching up. And at the bottom, you can see we like both investment grade and high yield corporate debt, as I said, rather than governments. So those are our asset allocation views, our tactical asset allocation views that you will see later on are reflected in the Horizon funds. Just covering a few other points if we move on, just to mention last year was a good year for performance of the funds. Why is that? I've just put a few very top level bullet points down. First of all, very importantly, we kept faith in equities. In the bear market of the spring of last year, lots of people were very cautious. We certainly kicked the tires carefully. We looked at everything, analysed the medium-term outlook, and reckoned that although equities were going to face a nasty short-term period ahead, there was real value to be had for the long term, and we stuck with them and indeed added in the difficult periods when there was real value in equities. Secondly, I've just said we favour Asia Pacific and US at the moment, but we did last year as well, those two, and they were the best performing major regions. So that was good. But very importantly, that last bullet point, we had some excellent performance in our regional equity funds at Columbia Threadneedle, largely due to focusing really carefully on companies of quality that could show growth in a difficult environment. And in a difficult situation like the one we've been through, it is crucial to pick the really strong companies with experienced management, good cash flows, sound balance sheets, and that did us very well last year. But I will elaborate a bit more later on about how we see style at the moment and growth versus value. But that was last year. Let's look at how we see things today. We still like the outlook for equities, and I've got 2 slides showing the main reasons for that. The first is this one, which I think really is the main factor that has kept us optimistic on equities: the huge action by central authorities, central banks and governments, to make sure that this pandemic didn't kill off economies. And you can see on the left-hand side, we've looked at monetary policy, what central banks are doing. First of all, they took interest rates down to 0 virtually everywhere. And this chart shows quantitative easing, i.e. purchases of bonds by central banks. And you can see huge spike up and a continuation of that process. And I mean, it was such a contrast to the global financial crisis, where the authorities were slow to react and did things gradually. This time, they immediately announced policies to do 3 times as much as they did at any stage in the global financial crisis. That's monetary policy. On the right, we've got fiscal policy, i.e. government expenditure. And again, you can see that the authorities went straight for big deficit, big spending to keep economies moving, and massive increase in debt and fiscal balances, which obviously has long-term implications, but it has meant that economies have been kept nicely afloat in a very difficult time. Next slide shows other reasons why currently we remain optimistic on equities. And if we look at the top left-hand side, that is global purchasing managers index indices. It is a very much watched economic indicator. It is a sign of ordering by companies for stock, parts, etc. And you can see that we really have had a very V-shaped bounce back. Last year, a lot of people talked about L-shaped recoveries, W-shaped recoveries, U-shaped recoveries, but really it's coming through in a pretty good, nice V shape. And as I said, that's business activity. But if you look at consumer activity, retail sales around the globe, housing around the globe, employment. In fact, I saw in the weekend press, it said that recruitment in March in the UK was the strongest it's been for 6 years in March. That's quite a bounce back. So we are encouraged by the recovery we're seeing in economies. Secondly, bottom left, companies are coming through in good shape. This shows the results of the last US corporate reporting season. So that was Q4 last year. And it shows the percentage of companies that beat market expectations, beat analyst expectations. So over 80% of companies were coming in ahead of forecasts. And that leads to upgrades in expectations for the future, etc., which is, and it's corporate earnings that drive markets. It's not economies, it's not politics, it's just corporate earnings. That's what you're buying, that stream of earnings. So that is good news for markets. And a few points on the right-hand side, the vaccine news, that is good and continues to be good. We all know about Pfizer and BioNTech and the Oxford University and AstraZeneca vaccines, but there's other ones coming through as well. Moderna, Novavax, J&J have all got ones that are in the final stages of approval. But there's others. Glaxo have got one in phase 2 trials. There's a company called Valneva and CureVac that have got vaccines in phase 3 trials. And the more vaccines we have, the quicker they can be rolled out and people immunized. So good news there. Election results in the US was a big issue last year. Biden's victory and at the same time his lack of a clear Senate majority, so there's checks and balances on what he can do, is a pretty good outcome. And finally, at the bottom, those bars, just to make the point that although it is a tough world in the COVID environment, and lots of companies without doubt are suffering, there are also a lot of companies that are well placed to benefit from it. And this is some of them. People with tomorrow's technology benefiting from the acceleration of trends from COVID are seeing some very impressive growth. And this is those companies, their Q4 2020 earnings compared to their Q4 2019, i.e. before COVID. And you can see they have come through 2020 showing very strong growth. And hopefully we've got good representation from these sorts of companies in the Horizon funds. So that is why we remain optimistic on equities. I mean, there's clearly risks out there. It's not all one way. Markets aren't as cheap as they were by any means. We may have further variations of COVID that cause problems, cause further temporary lockdowns in individual places. So we're not max on equities, but we do see further upside, and it is our most favored asset class. I said I'd come back to style and the sorts of companies we've got in the portfolios. If we look at the next slide, it shows the performance over the last year of quality, of growth, and of value. And you can see that quality and growth are the top two lines and have done very nicely until just very recently, and value down at the bottom has performed very disappointingly, again until very recently. So as I said earlier on, we've had a clear bias towards quality and growth, and that was very beneficial to us last year. But we always recognized that value wasn't going to underperform forever, and there would be a time when it would probably have a rally. And we did think that when the economic news looked better, which would probably be when we got good news on vaccines, that might change, and that was the case. Now, our view from here, if we look at the next slide, is that you should, broadly speaking, stick with quality and growth, and that is where we are. And the reasons for that are, firstly, it is still a tough world, without doubt. So you do need good, strong companies. Secondly, I hinted at those trends earlier on, and those companies with that bar chart that had done well last year. There were a lot of trends in consumer activity, business activity, that were very evident before COVID, and COVID has really accelerated those. And that we don't think is going to change. The shift towards online everything, streaming, cashless payments, cloud computing, virtual meetings, etc., etc., etc. And that chart at the bottom shows the percentage of the addressable market, i.e. retail sales, that are now done by e-commerce. And the dark blue line is the UK, the lighter blue is the US. And you can see a huge increase up to around a third of sales now online in the UK. And we think that trend is going to continue. Clearly, there'll be some moving back to the high street, but still, people have got used to doing things online. They see the practicality of it, and we think that will continue. So deep down, we think it's right to stick to the companies we really believe in. We think we've got strong management and, crucially, are well placed for tomorrow's business models and consumer world. But having said that, I mentioned that we did think there could be a bounce back at some stage in the value stocks. They had become cheap, and when the economic news looked better, people would have a bit more confidence in them. having a bounce. So we have added a bit to cyclicality and value. If we look at the next slide, it shows some of the things we've done. From an asset allocation perspective, we've added Japan to our favored list. And I said Japan was very much a market driven by global trade, so that should benefit from the cyclical pickup in economic activity. And the UK, likewise, I mentioned we've increased up from dislike to neutral, because it is a cyclical economy, and given our position on vaccine rollout and so on, and the huge pent-up demand there is from consumers to get out there and spend, we think that that will perform better in the short term. Also, from an asset allocation perspective, we have added a new fund to the Horizon funds, an equity income fund in the UK Equity Income Fund, because income stocks, generally, they're obviously the high yield stocks, and therefore, to get a high yield, you tend to be on a lower PE. You're much more the sort of value end of the market rather than the high growth end. So we have added a position there. And within the regional funds that we invest in at Columbia Threadneedle, those funds have generally added a little bit more on the cyclical end of things. So Europe, they've added to banks and airlines. Japan, the fund there is added to recruitment and housing, again, cyclical sectors. US added to building materials, railroads, a taxi business. When lockdown eases, people will be back traveling around. Emerging market funds added to retail operations. So we've shifted a bit more towards cyclicality and value for that bounce, but the bias of the portfolio is still favoring for the medium to long term those quality growth opportunities. If we move on to bonds, that's equities done. We think that the bond environment is actually quite a healthy one. I said interest rates are phenomenally low, and we think they will remain low. Quantitative easing is going to continue, so central banks are going to be buying bonds, which keeps the prices up. There are inflationary pressures that people are talking about, people are worried about, but we think they'll actually be fairly short-term and transitory. And I'll mention that again a bit later on. But that is why we've seen this increase in bond yields, i.e. a fall in capital value recently. But our problem with bonds is that there isn't really much value overall, despite the fact that the outlook looks perfectly reasonable. And these are the 10-year government bond yields in the US, the UK, and Germany down at the bottom, a negative yield. So as a result, we find bonds a less attractive area without doubt than equities. But having said that, within bonds, we can see areas of opportunity. And on the next slide, we show what we call the spread, which is the incremental yield that's available on corporate bonds over and above government bonds. And you can see that spread, that incremental yield, spiked up in the bear market when COVID was first diagnosed. It's come back a long way, but we still think it represents reasonable value. We're not looking for spreads to tighten much from here, but we do think there is a reasonable, what we call carry, i.e. each year you're getting an incremental yield of something like 300 basis points from high yield bonds and around 100 basis points from investment grade bonds. And we think that's worth having. And I mean, A, with a better economic outlook, that makes corporate credit a bit safer, and B, central authorities, central banks, QE programs are actually buying corporate debt as well as government bonds. So that gives them further support. So the bias within our bond portfolios is towards corporate bonds rather than governments. And I did say I'd mention a bit more on inflation, and on the next slide, we've got a look at inflation. Clearly, as I said, people are worried that with economies growing again, will inflation jump back up? That chart on the right makes it look as if inflation has been all over the place in recent years, but if you look at it closely, since 2020, since 2000 up to 2020, sorry, i.e. the last 20 years, inflation has actually in major economies shown there been within sort of 1% and 2.5%, i.e. consistently pretty low. And we don't think it's going to move out of that range much. It may nudge a little bit out of it in the short term. And there are short-term risks without doubt. And I've listed some on the left-hand side. There will have been some loss of capacity due to COVID, companies going out of business. There will be bottlenecks as people start to open up again. It takes time to get things working smoothly and efficiently again. There will be some increased costs due to COVID, distancing, etc., and due to Brexit in the UK specifically. And we've seen some of those issues at borders causing problems. But overall, we think that for the medium to long term, there will be a lot of spare capacity. And it's lack of capacity to satisfy demand that causes inflation. So we think that there is a lot of spare capacity. There's a lot of innovation coming through, a lot of automation coming through that will enable businesses to produce plenty of the things we need. And when it comes to labour, which is often the area you get that pinch point, you get wage inflation, we think that although recruiting is taking place now, there isn't really a shortage of labour, and there's a lot of technological developments coming along which again will free up labour and remove any shortages. Things like supermarkets without checkout staff needed, like Amazon are running already at the moment. Things like use of drones, further out, driverless deliveries, driverless vehicles, they're all going to free up labour. So we think inflation should remain low over the medium term. And if it does nudge up in the short term, then, as I said, we have a preference for equities over bonds, and equities certainly should be better placed in that environment. Just a couple of things to finish up with. Responsible investing is something that everyone is talking about these days, looking at more closely. We certainly are strong believers in responsible investing, ESG. Our research has ESG. Our research in all regions and all asset classes has ESG very much embedded in it. We've always liked well-run companies. They do well over time, and we think it's the same with responsible investing. Companies that are good at it, rate highly in our proprietary scoring system, should be the companies that are well run and do well over the medium to long term. And we do a lot of engagement with companies. That second bullet point there, we engage with around 300 companies each year, talking to senior management about any issues that we have to make sure that they're well run with regard to the environment, social activities, and good corporate governance. And I've just put a couple of examples of where that engagement has been successful in recent years. BT is one where we were concerned about the corporate governance. It was really around remuneration. They had a strange share scheme, but they explained that was because of the huge capex requirement for rolling out fibre. So this was a more suitable way of rewarding management if they were successful, and we accepted that. But the bottom point down there, we did think the level of reward potentially for management was excessive, and we got the maximum award reduced from 200% of salary to 160%. The second case is more looking at the social activities, particularly around employees at Uber. We thought that management weren't looking after those social activities in a good fashion. And after various meetings with senior directors and the chairman, they agreed to have a policy of enhancement of employee rights and particularly an executive pension scheme, their salary rewards linked actually to those policies. So another successful case of engagement with companies. Final couple of slides. One looking at the relative positions around the strategic asset allocation that we currently have or had at the end of the quarter within the 5 funds. And it is, as I said, reflects obviously the views we have about the asset classes. So on the left-hand side, the dark greeny greys, that's the bonds overall below the strategic benchmark in bonds, but having a bias within bonds to the corporate bonds, the third column from the left. Equities, the middle shade of green in the middle, you can see we're above the strategic asset allocation from E-value in equities overall, and particularly favouring, it says emerging markets, but that's because of that Asian opportunity there. So we like, on this grid, emerging markets. Japan, as I showed you earlier on, was overweight, and the US is where we particularly like. And that is where we are. And finally, to look at performance. And if we look at long-term performance, on the left-hand side, very strong performance from all 5 funds. If we look over on the right-hand side, we have to say performance is less strong. But I would like to make the point that this is within the peer groups, and particularly our more conservative, more cautious funds, number 1, 2, and 3, are in peer groups where the average fund tends to have much more in equities. So when you go through a quarter that's been really strong for equities, we have got a bit left behind. But you have to remember, we don't manage these funds specifically against the peer group positions. We look at asset allocations which we think are well suited to each client base on a risk basis. These are risk targeted funds, and over the long term we think they will do very nicely, but there will be periods of very strong equity performance where, compared to the peer group, we might not do as well.